My colleague is here. She will tell us about a whole host of brokerages and what they're saying on individual stocks. Ekta, over to you.
Hi, thanks Sonia for that. Well, I'll start with the banking space where Morgan Stanley has written on IndusInd Bank. They have an overweight call with a target of 1,700 rupees per share. According to them, it's a preferred pick amongst mid-sized lenders. They project a 26% core pre-provisioning operating profit growth for FY19 to 21. Morgan Stanley has also written on Yes Bank. They have an underweight call. The target is cut to 95 from 125. They've reduced the ROA or return on asset assumption for FY19 to 21 to 0.4 to 0.7% from 0.7 to 0.9% earlier. They're building in slower loan growth, lower fees and higher credit costs. Credit Suisse has written on Indigo. They maintain an outperform rating and the target is raised to 1,900 from 1,800 rupees per share. The yield spike is almost gone. They are positive on the company's positioning, sector and modest competition. Yields in Q2 would still be better on a year-on-year basis and the company is aiming to scale up its international business in FY20 as well. CLSA has written quite a somber note when it comes to the auto space. According to them, the state-wise analysis of the India auto volumes show ongoing demand slowdown is widespread. 90% of key states are witnessing weaker growth in two-wheelers and passenger vehicles in second half versus first half FY19. Rural-centric states have continued to grow faster than urban-centric, but the spread is narrowing now and they remain cautious on India autos given the weak demand and regulatory pressures and have a negative recommendation on 70% of their sector coverage.
Okay, Ekta, thanks a lot. We'll watch out for all these stocks. That CLSA report on autos is quite interesting. It's telling you the kind of slowdown that's there in that sector at least. Manisha Gupta will now tell us about all the commodity market action. Manisha, good morning.
Morning, Anuj. Thank you for that. Well, when it comes to the crude oil prices, which has been very, very volatile in last few sessions, on one side, it is about the tensions in the Middle East. On the other side, it is about statements and economic data, which have been slightly on the bearish side. To begin with, the New York business confidence sees a decline and the weakest in last 2.5 years. The recession fears there seem to be really growing. On the other side, there are statements from U.S. Energy Department stating that the U.S. shale output will hit record high in the month of July. Demand growth concerns is something that the markets are already dealing with. And then there is this OPEC meeting, which was earlier slated for 26-27 June. That is when the G20 meeting is also happening. So to avoid clash, 3rd to 4th of July is what was proposed by Russia. Now Iran wants that meeting on 10th to 12th of July. So with no meeting in sight and the 1.2 million barrels per day cut slated to expire by the end of this month, there is that bit of an uncertainty also creeping up in case of the crude oil prices. A lot of movement is also seen in case of the metal prices, where you have seen yet another day where there is decline in iron ore and steel prices. Aluminum is trading at a 29-month lows as well. We have seen prices decline by 2% in last two sessions. The only bright spots that you see in metal space are in copper. That is because there is a strike expected in one of the Codelco mines in Chile. And the other is nickel, which has continued to gain. That one is trading at a 2-week highs because of flooding in Indonesia and mining operations coming to a halt. That's the only metal actually which is also trading in the positive in Asia right now.
All right, Manisha, thanks a lot, as always, for giving us an update on the commodity space. Let's take a short break. On the other side, we'll be back with the pre-opening rates and we'll talk stocks with Prakash Diwan. Also, Udayan Mukherjee will join in for some market talk in just a bit.